If you could not work for 6 months due to illness or injury, how long could you survive financially? For most UK workers, the honest answer is not very long. Statutory sick pay in the UK is £116.75 per week. That is £506 per month. Against average monthly essential expenses of £800 to £1,200 for most people, that gap is enormous. And yet only 12% of UK workers have income protection insurance, the product that exists specifically to cover that gap. By the end of this video, you will understand exactly what income protection insurance is, why it is arguably more important than life insurance for most working adults, and what a basic policy actually costs in 2026. Income protection insurance is a policy that pays you a regular monthly income if you are unable to work due to illness or injury, not a one-off lump sum. A monthly income, typically between 50% and 70% of your pre-tax earnings, paid directly to you for as long as you are unable to work or until the policy end date, whichever comes first. Unlike statutory sick pay, which runs out after 28 weeks, income protection can pay out for months or years. The best policies pay until you return to work or until your chosen retirement age, whichever comes first. Here is a concrete example. If you earn £30,000 per year and you suffer a serious illness that prevents you from working for 2 years, a policy covering 60% of your income would pay you approximately £1,500 per month for the duration of your inability to work. That is the difference between managing financially and losing your home. The policy does not pay out immediately when you stop working. There is a waiting period called the deferred period, which you choose when taking out the policy. Common deferred periods are 4 weeks, 8 weeks, 13 weeks, or 26 weeks. The longer the deferred period you choose, the cheaper the policy, because you are agreeing to cover more of the initial period of illness yourself from savings or sick pay. Most people significantly underestimate the risk of being unable to work for an extended period during their career. The focus in financial planning tends to be on the risk of death, which life insurance covers, but statistically, you are far more likely to suffer an illness or injury that prevents you from working for several months than you are to die during your working life. Research suggests that 1 in 4 UK workers will be unable to work for a month or more at some point in their career due to illness or injury. The most common causes are not dramatic accidents. They are mental health conditions, musculoskeletal problems like back pain, and serious illnesses like cancer, all of which can render someone unable to work for extended periods without being immediately life-threatening. Without income protection, the financial consequences of an extended period off work can be severe. Savings depleted, debt accumulated, mortgage payments missed, investments cashed in at the wrong time, financial stress compounding on top of the health challenge that caused the problem in the first place. Statutory sick pay of £116.75 per week provides a floor, but for most people it is well below the income needed to cover essential expenses. Some employers offer enhanced sick pay, particularly in larger organisations and the public sector, but many do not. And self-employed workers have no sick pay entitlement at all. These two products are frequently confused, and it is worth being clear about the difference because they serve very different purposes. Critical illness cover pays a one-off tax-free lump sum if you are diagnosed with one of a specific list of serious illnesses named in the policy. Common covered conditions include cancer, heart attack, and stroke. You receive the lump sum regardless of whether you can work or not, as long as the diagnosis meets the policy definition. Once paid, the policy ends. Income protection pays a monthly income for as long as you are unable to work, regardless of the diagnosis. You do not need to have a specific named condition. If a doctor confirms you are unable to work due to any illness or injury, the policy pays. It covers the broadest possible range of conditions, including mental health, which critical illness cover typically does not. Both products have value, but they protect against different risks. Critical illness cover protects against the financial shock of a serious diagnosis. Income protection protects against the ongoing loss of earnings from any condition that prevents you from working. If you can only afford one, the case for income protection is generally stronger because it covers a wider range of conditions, pays an ongoing income rather than a one-off sum, and the risk it protects against, an extended period of inability to work, is more likely to occur than the specific diagnoses covered by critical illness policies. If you can afford both, they complement each other well. The cost of income protection insurance varies significantly depending on several factors: your age, your health, your occupation, the benefit amount you want, the deferred period you choose, and whether the policy is guaranteed or reviewable. As a rough guide for a healthy non-smoker in their late 20s to mid-30s, a policy covering 60% of a £30,000 salary with a 13-week deferred period and paying until age 65 might cost between £25 and £50 per month. For a £40,000 salary, the equivalent policy might cost £35 to £70 per month. These are illustrative figures. Actual premiums depend heavily on your individual circumstances and the insurer. Getting a quote from an independent protection insurance broker is the most reliable way to understand what a policy would cost for your specific situation. There are two main premium structures worth understanding: guaranteed premiums. The monthly cost is fixed for the life of the policy and will not increase unless you change the policy terms. More expensive initially, but provides certainty. Reviewable premiums. The insurer can review and increase premiums periodically, typically every 5 years. Cheaper initially, but less certain over the long term. For most people, a guaranteed premium policy is preferable because it removes the risk of significant future premium increases at a time when you may be older and in poorer health, making switching to a cheaper policy more difficult. When comparing income protection policies, here are the key features to evaluate. Own occupation definition. This is the most important feature of any income protection policy. A policy with an own occupation definition pays out if you are unable to do your specific job. A policy with a suited occupation or any occupation definition only pays out if you are unable to do any job that your education and experience qualify you for. Always aim for own occupation cover if possible. Benefit amount. Most policies cover up to 60% to 70% of pre-tax income. This is typically sufficient to cover essential expenses. Check whether the benefit is paid before or after tax. Most income protection benefits are paid tax-free if you pay the premiums yourself. Deferred period. As discussed, the longer the deferred period you can afford to self-insure, the lower the premium. If you have a solid emergency fund of 6 months of expenses, a 26-week deferred period makes sense and significantly reduces the cost of the policy. Indexation. Some policies offer inflation-linked increases to the benefit amount, so your payout keeps pace with rising costs over time. Worth considering for long-term policies. Back to work support. Many insurers now include rehabilitation support and return to work assistance as part of their income protection policies, a useful additional benefit worth checking for. Income protection is most important for people in these situations. Self-employed workers. With no sick pay entitlement whatsoever, self-employed people are the most exposed to the financial consequences of being unable to work. Income protection is arguably non-negotiable for anyone who is self-employed and relies on their own labour to generate income. People with dependents. If others rely on your income, the financial consequences of an extended illness are not just personal. They affect everyone who depends on you. People with mortgages. A mortgage is a large fixed monthly obligation. Missing payments has serious long-term consequences. Income protection specifically designed to cover mortgage payments, sometimes called mortgage payment protection insurance, is worth considering alongside or instead of a broader income protection policy. People without employer sick pay beyond statutory. If your employer only offers statutory sick pay, you are most exposed to the income gap that income protection fills. People with limited savings. The smaller your emergency fund, the more important income protection becomes. If you have 6 months of expenses saved, you can self-insure the initial period. If you have 1 month, you cannot. Income protection is less critical if you have very substantial savings that would cover an extended period without income, significant employer sick pay that would cover most scenarios, or a partner whose income alone could cover household essential expenses indefinitely. To bring it all together, income protection insurance pays a monthly income if you are unable to work due to illness or injury. Only 12% of UK workers have it, despite 1 in 4 being unable to work for a month or more at some point in their career. It is broadly more useful than critical illness cover for most people, because it covers any condition that prevents you from working, not just specific named diagnoses. For a healthy person in their 30s, a policy can cost as little as £25 to £50 per month. Look for own occupation definition, guaranteed premiums, and a deferred period that matches your emergency fund length. And if you are self-employed, have dependents, or have a mortgage with limited savings, it should be a priority. The question is not whether you can afford income protection. For most working UK adults, the question is whether you can afford not to have it. If this video helped you understand income protection for the first time, subscribing takes 2 seconds and means you won't miss a video. We post twice a week on making your money work harder in the UK, and next up we are covering UK student loan repayments, Plan 1 versus Plan 2 versus Plan 5, and whether you are actually paying yours off or just paying interest.